What if I told you that every time a bank approves a loan, it creates brand new money that didn't exist a second before? That's not a fringe theory. It's exactly how the Bank of England describes the modern financial system. But wait, doesn't the central bank print all our money? Actually, most money in the economy is created by commercial banks. Not by governments, not by printing presses, by banks making loans. Today, we're going to follow that surprising truth, step by step. We'll see how a simple mortgage can create money, why you shouldn't think of banks as just middlemen, and what really limits their power. Let's start with the single most important idea. When a bank makes a loan, it doesn't hand over existing cash. Instead, it creates a new deposit in the borrower's account. That deposit is spendable money that didn't exist a moment ago, so broad money in the economy goes up. It's a double-entry bookkeeping magic trick, one that creates an asset for the bank and a new liability at the same time. Think of it as this: a loan equals a new asset for the bank and a new deposit for the customer. Two sides of the same coin? Let's make it concrete. Imagine you walk into a bank and get a mortgage for £100,000. The bank approves it. Instantly, your account is credited with £100,000. That money wasn't taken from a vault of savings. It was simply typed into existence as a number in a computer. A new deposit. You then use that deposit to pay the house seller. The seller's bank now has a larger deposit, and the banking system as a whole has more money than before. That's it. No armoured truck delivering cash. Just digital entries that represent real spending power. And if you later repay the loan, that deposit is extinguished. The money is destroyed just as it was created. This flies in the face of the old textbook story, where banks simply lend out deposits that savers have already parked. The Bank of England's own 2014 paper says that story is inaccurate. The reality is this: banks do not first collect deposits and then lend. They lend first, creating a deposit, and then worry about reserves and funding afterward. That reversal is the key to understanding modern money. Let's dig deeper. Why does this matter so much? Because in the UK, around 80% of all money is just electronic deposits, created by banks when they lend. Only a tiny fraction is physical cash printed by the central bank. So when we talk about the money supply, we're mostly talking about the banking system's digital IOUs, not government-printed notes. That means the health of bank lending directly affects how much money flows around the economy. So if banks can create money by lending, can they just create infinite amounts? Get rich with a few keystrokes? No, there are real constraints, and they're not just reserves. Capital, liquidity, risk, and competition all bite. First, capital. A bank must hold enough shareholder equity relative to its risky assets. Think of capital as a safety cushion. If loans go bad, the cushion absorbs losses so depositors don't lose money. The more loans a bank creates, the more capital it needs. That's a hard limit. Second, liquidity. Even if a bank has enough capital, it must have enough liquid assets to settle payments. When you transfer mortgage money to the seller's bank, your bank loses reserves. If it runs too low, it can't function. That's why banks offer high-interest savings accounts, to pull in deposits that bring in reserves. Third, competition and profitability. A bank can only lend if there are creditworthy borrowers willing to pay interest. If the central bank raises rates, lending becomes more expensive, which curbs money creation, and every loan carries credit risk. So banks are cautious. So banks don't operate in a vacuum. The whole system constrains their money creation ability. Now let's look at a less obvious example. Your credit card. When you buy something with a credit card, the bank creates a loan and a new deposit for the merchant. Money is created when you pay off your balance at the end of the month. That deposit is deleted. Money is destroyed. Simple routine happening millions of times a day. You might have heard of quantitative easing, QE. Isn't that also money creation? Yes, but it works completely differently. QE involves the central bank buying government bonds, paying with newly created central bank reserves. But those reserves are not the same as spendable deposits. They stay inside the financial system. So QE can influence interest rates and asset prices, but it doesn't directly put money into people's pockets the way a bank loan does. Academics call this an endogenous process. The amount of money isn't set by the central bank from outside. It's created inside the banking system in response to demand for loans. That's why modern research focuses on balance sheets and funding structures, not the old money multiplier. Here's the mental model to take away. Banks don't find money first and then lend it. They create a deposit by lending, and then the rest of the system adjusts around that decision. This explains why housing booms and rapid credit growth go hand in hand. More mortgages mean more newly created deposits chasing houses. It also explains why financial crises are so destructive. When banks stop lending, money creation stalls, and the economy can seize up. So why can't any company create money by issuing credit? The answer lies in the payments system. A bank deposit is accepted as final settlement between any two parties. It's part of the national money supply. A corporate IOU is not. You can't use it to pay taxes or settle a debt with a stranger. Bank deposits are the economy's accepted form of money. That special privilege is tied to regulation, deposit insurance, and access to central bank reserves. When a non-bank lends, it just moves existing deposits around. It doesn't create new money. The old money multiplier story says banks need reserves first, then lend a multiple of them. That's backward. In reality, central banks provide reserves after lending decisions are made. The paradox is that our public money supply is created by private profit-seeking firms. That's why regulation is so essential. Capital rules, liquidity rules, and supervision are the guardrails that keep the system from driving off a cliff. In our system, money is debt. Specifically, the debt of banks to the public, created through lending, and that means we collectively shape the money supply through our own borrowing and spending decisions. No system is perfect. The current one has given us growth, but also repeated crises. Understanding its mechanics is the first step to making it better. Banks create money by lending. Loans create deposits. Deposits are money. Repayments destroy money. Constraints shape the flow. That's the engine. Everything else is tuning. Stay curious. Question what you learned in school. The real story is always more interesting. Thanks for watching. If this video helped you, share it with someone who still believes banks just lend out savings. See you next time.